Hello, and welcome to our webinar, Compliance Analytics 101, Next Gen Effectiveness Measurement. Thank you for joining us today. A few housekeeping items I wanted to mention before we begin. Please submit your questions in the questions section of the GoToWebinar console. We plan to cover a lot of information today, so if we don't get a chance to answer your question during the session, we will make sure to follow up with you afterwards. You'll also receive a request to fill out a survey immediately following the webinar. Any feedback that you provide is very much appreciated. We'll also circulate these slides to all of you after the webinar, so don't feel like there's a need to take extensive notes or anything like that. And for any additional questions or inquiries you have, please feel free to email us at info@lextegrity.com. So today, our agenda is pretty packed. We've broken out this webinar into several parts. I'll begin with a quick introduction to myself and Lextegrity. We'll then discuss compliance analytics and the critical role compliance analytics can play in ensuring your compliance program is truly effective. I'll then talk about the first generation of approaches to measuring the effectiveness of your compliance program, and then compare those to some of the next generation approaches to measuring compliance program effectiveness. And finally, in the second half of the webinar today, we'll go through a really technical deep dive on the three legs of the compliance analytics stool. That's the metaphor we're using today. The three legs of the stool, which is data, methodology, and process. So with that, I'll do a little quick introduction to myself. I'm Parth Chanda. I'm the founder and CEO of Lextegrity. I'm a lawyer by training. I spent about a decade in-house. I was originally a white-collar lawyer focused on the FCPA at Sherman and Sterling in New York. I was involved in multiple monitorships at Sherman and Sterling, and then went in-house at two organizations in the midst of active DOJ and SEC investigations, Avon and then Pfizer, where I led both companies' global anti-corruption compliance programs. And in those experiences, I got to really revamp compliance systems, including implementing global compliance analytics programs. And in 2017, I left Pfizer to launch Lextegrity to really bring advanced tools, particularly those involving compliance data analytics, to companies globally. And you have my contact information. I'm also on LinkedIn. Feel free to reach out and connect. So just a couple of quick slides on Lextegrity ourselves, who we are. We're a technology company. We provide compliance data analytics and workflow software for more effective compliance to global organizations. We do that by offering stronger front-end prevention and back-end detection tools for risk, and really focus on risks like corruption, fraud, kickbacks, sanctions, channel stuffing, etc. Tools developed really by a team of former in-house and external compliance and audit experts, and you can see some of the companies we've worked at. Our platform uses advanced fraud detection techniques. We risk score 100% of a company's spend, revenue, and expense data. And our workflow products automate approval processes like third-party due diligence, gifts and hospitality, conflicts of interest, HCP engagements for life sciences companies, et cetera. Our team has extensive experience working with companies of all sizes across the maturity curve, and you'll see some examples here. Finally, and very uniquely, we really have established a proven track record with enforcement agencies worldwide. We've been selected in 12 enforcement matters spanning 7 countries. We've helped resolve 2 DOJ SEC monitorships and are working on a third one now. And we've even helped to secure a DOJ declination. And in that matter, we were cited by the SEC in our client's resolution as a significant remediation factor, in particular, our data analytics solution. So we hope some of that experience it will be reflected in the rest of the webinar today, because we really have brought a real depth of knowledge and experience prior to Lextegrity and through Lextegrity in this space. This slide, and again, these slides will be provided to you, have some quotes from some of our customers, 2 of which were in front of the government and active DOJ and SEC matters, and you can click on the links to see more detailed case studies. So with that, let's dive in. So I wanted to share just this one slide with quotes from various enforcement agencies, DOJ, SFO, and AFA in France, just to really highlight that enforcement agencies have been very clear that they consider an effective compliance program, to be one that both prevents and detects non-compliance. We're not going to spend much more time than just this one slide. The DOJ in particular has really upped the ante here. This quote from Ken Polite, who's now the former head of the criminal division, who was the head of the criminal division at the time, he says, "Has your employee been informed, trained, and empowered to choose right over wrong? Or if he makes the wrong choice, do you have a system that immediately detects, remediates, disciplines, and then adapts to ensure that others do not follow suit? So the prevention side is well covered in most organizations. Training, policies, etc., procedures, systems. But a lot of companies today cannot really meet that standard that Mr. Polite sets forth here of immediately detecting and remediating so that non-compliance is a singular event and is not repeated. And from my perspective, real-time compliance data analytics is really the only way to meet that standard. But ultimately, I only included this one slide on enforcement expectations because most companies are never going to end up in front of enforcement agencies. And ultimately, and most importantly, the idea that you want a program that does its best to prevent noncompliance and then detect it as quickly as possible should really be everyone's definition of an effective and sound compliance program. So really having real-time detective monitoring using data analytics, I mean, that will help you as a compliance officer in so many ways, but ultimately help you sleep better at night, knowing that your preventative controls, your training, your policies and guidance are in fact working, while knowing that, if they don't work on an edge case or with a rogue employee or third party, you're detecting that noncompliance immediately and stopping it before it becomes really systemic. So with that, let's move on to the next slide to really talk about what I described earlier as this first generation approach to measuring the effectiveness of your compliance program. So the first generation approach really, as compliance professionals like myself have seen for the past 10 to 15 years, has really been focused on data that's pretty static and post hoc in many ways. The biggest data set that companies have really relied on is helpline matter data, whether reporting data as well as probably more importantly, substantiation data. So how often are we getting reports and then how often are we substantiating those reports and finding true non-compliance? And that's been the biggest driver of measuring the effectiveness of compliance programs. And that data is definitely compelling. Don't get me wrong. If you're substantiating investigations related to non-compliance, that data can show you definitively that you have non-compliance, control gaps, potentially other problems. You have weaknesses that you need to really fix. But this data, the substantiation data, reporting data, can't necessarily tell you if your program is affirmatively effective. It can tell you your program is not effective if you have substantiated matters. But if you don't have helpline reports or you have helpline reports that you can't quite substantiate, can you really conclude that your controls are adequate and that your program is effective in practice? From my perspective, you really can't. And it may be that someone just hasn't reported something that's going on due to fear of retaliation or other factors. The ACFE, the Association of Certified Fraud Examiners, is a great organization. They report it takes about 18 months for someone to report a fraud, for example. So, maybe the noncompliance is going on, maybe it's spreading, but it just hasn't been reported yet. So the key takeaway for me is that it's really tough, again, to draw an affirmative conclusion that your program is effective based on a low number of reported or a low number of substantiated matters. Other metrics that compliance organizations often use, I put in a maybe even less helpful bucket in terms of assessing the effectiveness of your program. So code of conduct certifications, training statistics, the number of third parties you've onboarded, their risk levels from your third party due diligence, what categories they're in, and so on and so forth. All of these things are essential processes and controls that a company has to have in place on the preventative side. Don't get me wrong, but most of the data coming from those processes, all they really tell you is that those processes have operated and have worked on some level, but they don't necessarily tell you if the underlying intent and data is correct. So, if you've had code certifications that are completed and 99% of your employee base say they don't have anything to report and they've complied with the code of conduct, all those stats tell you is that 99% of the people have answered the question that way. Do they tell you that 99% of those people truly have nothing to report or are complying with the code? No, because they're self-certifications. They're based on the good faith of the respondents and the accuracy, them understanding the question in the first instance and answering it truthfully and comprehensively. And that doesn't happen in some cases. Again, it's going to happen in the vast majority of the cases, but it's probably going to happen in more cases than you necessarily caught if you're just looking at your code certifications. So again, I think a lot of these things are table stakes, are important, very important parts of your compliance program. But in terms of measuring your program's effectiveness and whether there are instances of true non-compliance happening in your business, they're limited in the same way or even more so than your helpline statistics. So moving on then to some common approaches in this sort of next generation approach. This is where more robust data analytics approaches come in, particularly looking at transactional data to identify non-compliance. So we're going to focus today really on financial risks like bribery and corruption, fraud, embezzlement, and asset misappropriation, kickbacks, sanction violations, channel stuffing with your distributors and the like. In that space, using real-time transactional data from your financial systems, such as your ERP, your SAP, your Oracles of the world, or your T&E systems like Concur, that kind of data can really help your organization find any anomalies or risks in a larger transactional set that might be indicative of non-compliance in one of the areas I just mentioned earlier. So we're going to look now at some common approaches that organizations that are moving further up the maturity scale have taken, and some that we've seen companies take. The first approach here on the left that we often see is dashboarding and visualization. And this is a space that's very alluring because, it's nice to see data visualized. Humans are visual creatures. It's nice to see data not as a bunch of numbers, but to see it visualized in charts and graphs with nice colors, etc. And it's relatively straightforward to do. Most organizations have licenses to visualization software like Tableau or Power BI, or similar tools. And they often have folks within the organization who know how to use those tools, even within the compliance organization. So it's often somewhere where organizations start this process. And ultimately, you can drive a lot of visualizations where you believe that you're going to get insights through things like, for example, scatter plots. So, I want to see a scatter plot of my travel and expense spend in high-risk markets or by market, like in China, for example. I want to see my T&E spend because I want to see who the highest spenders are in that market. And that presumably is going to give me some insight in where there might be risk. And you could build a very nice dashboard. You can see a lot of dots up in the top right corner where you see a lot of money, a lot of frequency of spend. But taking that data and visualizing it, taking that T&E spend data and then visualizing it is not necessarily analytics. It's visualization. Analytics is really about driving insights from that data. So when you visualize data, you might be looking at outliers, but you're looking at those outliers in one dimension. So using that example I just gave, looking at the amount of spend, you may see a lot of data points clustered in the upper right-hand corner of the chart, but there may be completely legitimate reasons for that. For example, your country manager in the market may be one of your highest T&E spenders because she travels a lot, as she should, as the country manager. But there may be no risk there or very little risk there. And your risk might be with a sales rep in the middle of your scatter plot who's not spending nearly as much money as your country manager because they're not taking these long haul flights, but their total amount of spend is not really an issue, but maybe their frequency of spend is an issue with a lot of smaller value spend, but it's happening with really off the charts level of frequency. So they're having multiple meals a day with customers and prospects and things like that. So again, if you're looking at it from just that one dimension of total spend, you're going to potentially miss the true outlier from a risk perspective who might be somewhere in the middle of your scatter plot because the human eye is not necessarily going to be really strong enough to get that insight just by looking at those dots. So again, your risk may be somewhere in the middle of that visualization and not clearly defined. And so we've talked to a lot of companies over the past 6 years that we've been 6 or 7 years that we've been doing our work at Lextegrity, and we've talked to companies who've gone very far down the road of dashboarding and visualization. even to the point of doing things like creating visualizations for their country managers or country finance team to review and in theory own their own compliance. And that sounds great again in theory, but what we've learned and seen firsthand with talking to some of these organizations is that when those dashboards are then sent out to those country managers and to country finance, they often come back and say, I don't know what to do with this. What do I look at? How do I parse this visualization down into those critical individuals, vendors, transactions, distributors that I need to look at? You tell me what I should be looking at and for. And then they often then come back to the country compliance officer and send, ask for more help. Tell me which vendor should I look at? And then the country compliance officer often doesn't really know how to manage that visualization data either. And so you end up putting in a lot of effort and often end up creating a bunch of documentation or visualizations that are not as actionable as you hope. So, visualization alone without more risk analysis built in can actually be quite limited, which takes us to the next approach here, which is really going to talk about one-off key risk indicators or KRIs based on that transactional data. So, for example, your team might create a report of, instead of a visualization, might create a report of all vendor payments to offshore bank accounts or the largest round currency payments. Again, those are two key risk indicators: offshore bank accounts, round currency payments. So, 10,000 euro on the dot payment, 50,000 Brazilian real payment, etc. You shouldn't typically see that many round payments, and again, offshore bank account transactions either. And they can be indicative of risk for sure. And if you see a spike in these types of things, a spike in offshore payments, it may be that there's some inappropriate behavior underlying it. But the challenge here is when you take these one-off key risk indicators and you take them one by one, you have the same unidimensional problem. You can have a huge false positive risk because you're chasing this one dimension of every transaction you're examining. And it can create a ton of busy work where you don't ultimately get to a lot of risk within your data analysis. So let's take that offshore bank account payment example again. If you had a list of all your offshore bank account payments, you might run into issues with companies that are working in countries with high currency fluctuation issues where they have very legitimate reasons for why they have a bank account in another jurisdiction. So you may be chasing a lot of false positives and may not be driving as much value or insights from that KPI standing alone. And if you have a transaction or employee hitting that KRI, but then also hitting another KRI that you've set and another KRI you've set, it's often quite difficult in an approach like this to combine that information and to pull out that one employee or vendor or transaction that hits those multiple KRIs because you're usually getting a report of each of these one-off KRIs in a separate spreadsheet or a separate list. And so it's really hard to connect those things together, which kind of is a natural segue to the next approach, which is really aggregating those key risk indicators to get to an aggregated risk score for the transaction. And this is an approach that we're big proponents of for organizations. We think this is the best in class approach, one that we know firsthand that the enforcement agencies are very keen on companies following. And so this one takes the best of the KRI approach, but it takes it to the next level. It takes each of those KRIs, separately weights each of those risk indicators, and then aggregates them up for a total transactional risk score. So now you're taking those vendor payments that were offshore, but finding ones that were also that also had other risk factors. So it was offshore, but it was also expedited. It was in a round currency. It was for a round currency dollar amount. It was also a statistical outlier in terms of the amount, and it was hitting a high risk GL account that we were already worried about. So that aggregated risk score for that transaction would be very different than a transaction that was just offshore alone, because you're getting these additional risk factors that are combining to give it a higher aggregated risk score. So now you want to really weigh those key risk indicators so that your most important key risk indicators flow up to the top. And you want to also learn as you're scoring these things and adjust your risk scoring settings and things like that to lower the false positive risk over time and become more and more targeted in your aggregation and in your risk scoring. So this approach really helps pinpoint the focus of your compliance team, audit team, country managers to know those transactions that they should be chasing, not a handful of dots on a spreadsheet that they have to parse themselves, but information that's already parsed to say these 10 transactions are the ones that you need to focus on, and it's a clear and defensible way to look at things. It looks like we have our first question, so I'm going to jump over there before I jump over to machine learning and AI. So the question asked, you mentioned scoring the transaction. What do you mean by that? Do you mean scoring the payment? Okay, well, great question. So, the optimal approach here, I would say, and the one we take at Lextegrity, and we've seen other companies take, is combining all of the elements of, and we're talking about a vendor payment right now, but this would also apply for a T&E transaction or a customer revenue or distributor transaction, is combining all of the elements of the payment and combining them all into one transaction review. So for example, you want to connect your purchase requisition, purchase order, invoice, and payment detail into one transaction that's scored and reviewed. That's really critical here. And we've seen companies take more what I'd say first generation approaches, of scoring the purchase order, then scoring the invoice, and then scoring the payment item, and in each alone. So you have 3 parts or 4 parts that each have separate risk scores. And it's first generation because it's much more simplistic. It's each of those data sources don't need to be combined, and they can be separately scored. So that's why it's much more basic. But the downside, and the serious downside of that, is scoring each element separately will mean that you needlessly are multiplying the number of results you need to review, since the PO, invoice, and payment item may all end up high risk, and now you need to review 3 really duplicate items rather than one item. So that's the first downside of this approach, that it's gonna almost exponentially increase the number of things you have to review because you're duplicating your scoring and you're duplicating your review work. And if you have false positives, now you're multiplying the number of false positives that you're having to clear, absolutely needlessly. But I think in my perspective, the second important thing is by combining all of these transactional elements, the purchase requisition, purchase order, invoice, and payment, you're also unlocking specific powerful analytics. So for example, the timing of these things, an expedited payment, if that looks at the days between, for example, the purchase order and the invoice coming in, but it also looks at the time between the invoice coming in and the payment going out. So if either of those things happen, unusually quickly, the vendor invoices the day after they get their PO, or the company pays the invoice the day after getting it in, and not, net 60 days or net 90 days under your company's policy, those factors might raise some risk, and you lose a lot of that analytic heft when you're just scoring these things in a much more basic approach of, one at a time separately and not in a combined way. So I would say it's a great question. I would say I'd be highly skeptical of an approach that scores these things separately, these items separately. Stay away from those kinds of really basic, kind of early approaches. I think those were approaches that were taken maybe 5, 10 years ago, and really look at a more robust and modern approach, which is looking at all of the components together, and scoring the overall transaction at once. It's going to be much more effective and as well as much more efficient. So great question. So maybe just to close out this slide, please keep the questions coming. And so maybe to close out this slide, machine learning and AI, definitely the hottest topic right now. ChatGPT obviously opened the floodgates to AI. And there's obviously huge interest in AI and machine learning in this space. We're big believers that the AI has a powerful role here, but that going with an AI approach first out of the gate, where you're using models that are quote unquote completely unsupervised, where you're just bringing in data, applying AI model to it, and then hoping that you're going to find fraud, bribery, corruption, etc. we haven't seen, really anyone do that successfully, and we're highly skeptical that that's, the approach. We think it's a mix of rules-based analytics and then learning from those rules and having machine learning that improves over time. But there's some critical elements here that are challenges for organizations to implement these things. You need data to train your model. The better your underlying data analytics rules are, the better your training data will be. So for what we just talked about in terms of approaches that score each of these items separately, you're going to have much worse training data, a lot more false positives rather than true positives for your training model to learn off of when you use a more simplistic scoring methodology. When you use a more robust scoring methodology, you're going to have better examples of potential fraud, bribery, and corruption for your model to learn on. And then obviously, if you're trying to build something like this internally, you're going to need really specialized expertise in AI, data science, et cetera. That's really not that easy to find in the marketplace. So again, I'm a big believer, as our team, we're a big believer that best approach combines, more advanced aggregated rules-based scoring and then machine learning over time that trains on your score transactions to improve your scoring over time. And I think from the machine learning analysis that we've done, on our data, our accuracy scores are much higher than some of the competitors we've seen in the marketplace who are have a less mature, I would say, risk scoring model to begin with. So again, I think these are some of the common approaches, and we're going to really deep dive now a little bit more into what that aggregation means and really visualize it for you here so you can really understand what I mean by aggregation of key risk indicators. So here are some examples in the 3 different domains. These are the 3 different domains where Lextegrity specifically works: employee expense, the T&E, vendor spend, which is procure to pay, and customer revenue, order to cash, which are your customer transactions as well as your distributor transactions. So from a high-risk transaction perspective, that could mean a specific transaction hitting multiple of these key risk indicators. So we may be applying 15 or 20 different key risk indicators to each transaction. And so here on the left, you have a T&E transaction. So maybe this is a meal. And you have multiple attributes here that are potentially anomalous. So you have an unusual cash amount, a round dollar amount, no receipt, etc. And so for this type of transaction, it's a hit because you're looking at all of these things together. It's also aged expense. The employee took a long time to submit this, so maybe there was something wrong with it. Maybe they were waiting for a new manager to come in, so they could kind of slip it by their manager. So it's, again, a combination of all these risk factors together that you don't see coming together that drive the score. And you'll see one interesting one here, superior in attendance. So this is one where we're looking at the submitter of this meal expense included their manager as one of the attendees. So this could be, that's a common way for folks to sidestep controls where a manager who's colluding with the employee can now approve that expense, or maybe it's their own expense and they can do some self-approval of it. And so this is an example of where, layering on things like HR data on top of your T&A data can really generate additional special analytics like the self-approval analytic that we showed here. So again, aggregating these multiple key risk indicators is ideally going to bubble up to the surface the transactions with the highest risk. On the vendor side here in the middle, you'll see another example of a payment to a third party where they're potentially a duplicate vendor, they potentially have a duplicate invoice, it's paid very quickly. There's a potential conflict of interest hit where the vendor's address attributes match the an employee's address information from the employee master file. So the vendor master file and employee master file have some attributes that match, and together these attributes bubble up this transaction to the surface for review. And if this is non-compliance, if something's gone wrong with this vendor, you're going to be seeing this ideally in real time. So if you're getting a daily data feed, and we'll talk obviously a lot about this in the second half of today's webinar, if you're getting a daily data feed, you're finding this transaction the day after payment. And so or days after payment. So you're going to be flagging this, very quickly. I'm not going to go through the customer revenue example, but similar, multiple attribute elements here that could get triggered up. So in terms of then what a compliance monitoring approach looks like at a high level, it's really these three elements: data, risk algorithms, and then review and insights coming out of that process. So the data piece, this is where we typically, from a financial data perspective, we take ERP data, T&E data, HR data, and even approval and due diligence data we can bring in as well, to do some special analytics on whether your spend is correlating to the approvals that you've approved for that spend. And so bringing in that data, aggregating that data, mapping that data, et cetera, which we'll get into a lot more detail in the second half. Then now that you've had that data, really applying these sophisticated risk analyses and algorithms to it. So behavioral, statistical, policy, rules-based elements, and then the machine learning coming out of that as well, driving that risk score, as I mentioned. And at the end, that producing results. So aggregated transaction risk scores, high-risk transactions that are flagged, going into a workflow with a review and remediation, and then visualizing that data. So now when I talk about visualization of the data, we talked about kind of some of the limitations in dashboarding, the dashboarding approach. The risk visualizations here would then have that risk lens as well. So this would be, show me our highest T&E spenders in China, but with the highest risk scores. So the X and Y axis could be spend and risk score. So now you could see that you might have someone in the middle with lower spend, but their risk score is super high. So they're not in the top right corner of the visualization, but maybe in the top middle. But because of their risk score, it's going to be an employee that you might want to look at more closely from a transactional perspective. So very quickly on this slide, I wanted to just take that previous slide and show what that could look like in a system. And this is just using some screenshots from our system, but you could have a similar system where you're bringing in enterprise data. You have a whole area where you can set your risk engine settings, your thresholds, et cetera. You have a output with a monitoring review, with a workflow, and then you have a risk visualization, risk insights perspective as well part. So these are all the elements of a program, a data analytics program. Here, we want one level deeper, kind of lifted up the hood to kind of show you, and I'm not going to go through this in a lot of detail, but show you all of those elements from gathering data to building a risk engine server and database to that monitoring review, monitoring insights, risk engine settings, all of those parts that we cover from 1 through 7 in our tool. If you were to build something internally, I'll give you some transparency in terms of the types of technologies as well as human resources you might need internally to build each of those components. I hope I've set some of that basic groundwork for you in terms of what the goals are of this process. But here we're going to look at continuous monitoring and look at it from a metaphor of a stool with 3 legs: data, methodology, and process. The first leg of the stool is data, and so we're going to dive into that. And so the first step of data here is preparation for analysis. There's really 3 parts of the data: preparation for analysis, automation, and harmonization. Preparation for analysis is really about understanding your data sources and your end goal in terms of having kind of what we call a unified data model for your analytics engine. So, you want to get to the point where you're monitoring and analyzing your data. And to do that, you have to prepare and understand what information you want from your source systems to do that analysis, and then start tracing that back to the underlying data sources and data sets that house this information. So some examples of data sets, we connect to or Concur, SAP, Oracle. The data gets structured and organized by those applications. And so for these systems, we determined or have determined what data we need to analyze, and where that information is located in that core system. And then we trace the data all the way back. And this is not a trivial task. This is a pretty heavy lift with each new data system. So these visualizations on the right kind of give you a sense of the complexity here. So, the first image at the top, the background image, that represents SAP, a pretty complex platform that many of you might be familiar with. there's countless data tables within SAP, but only a select few are really truly pivotal for compliance data analytics. And those tables, they house, the foundational data that you need for your analytics journey. And this representation here really illustrates the data's origin and flow from those various tables in SAP to something that can then be analyzed. So we can show you how, we prepare the data and in a way to create data sets that can then be used for further follow-up. The black image at the bottom here, that shows a data model. So this is highlighting kind of the intricate web of relationships even within the data, and so that shows you how parts of the data may rely on other parts of data. And it really is, kind of just here to show you as a reminder that this data can be actually very complicated in terms of its interrelationships. And, it's this part that's really one of the reasons why you want to turn to a skilled provider who's done this many times, and, why companies turn to, companies like Lextegrity. We've done all of this data preparation and analysis work and, deployed it to multiple companies. So there's really no need for our customers to even look at charts and graphs or visualizations like this, because we're not reinventing the wheel every time we're doing this for a new SAP, Concur customer, etc. So, I just want to use these examples to kind of show you the importance of tracing your data, and then also want to underline maybe another point about reference data, sometimes often overlooked. And by reference data, I mean, kind of additional supplemental data that's in SAP or Concur that's very useful for your analyses to kind of normalize your analyses. So payment method is a good example of reference data. SAP, may have 30 for your company, may have 30 different payment methods in your SAP data, but they can usually be broken down just into a few, manual payments, check, wire, ACH. On the T&E side, your company might have 250 different expense types in Concur or your T&E system, but many of those can be grouped together. They may have, you may have 5 different airfare categories that can be combined into airfare. And by combining, you're actually, helping not dilute your analytics and, kind of making more like-to-like comparisons in your data. Because if you, just have one category of airfare that's used in a very small number of transactions, you're not going to really be able to, you might not be able to get a lot of insight on whether those transactions are anomalous unless you combine it with all the other airfare transactions. So really, again, an expert partner who's done these kind of reference data mappings is also kind of critical to expedite this whole process for your team. It looks like we do have 2 more questions. I did expect more questions to come in as we got into this technical area. So the first question is, how do you advise companies who have multiple systems? How realistic are these approaches when you do have multiple systems? So great question, and one we hear often, to be honest. So, I would say one of the first questions to ask yourself is, how many systems, like for any organization when they're going down this road, is do that kind of high-level inventory of how many systems do I actually have, of data that I want, that house data that I want to bring into my compliance analytics program. If you have multiple systems, that will make it more challenging than having one system, for sure. But having multiple versions of, from my perspective, having multiple versions of the same system, for example, one new instance of SAP S/4HANA, which is their, newest system, and 3 old, ECC 6 versions, which is kind of the pre-SAP HANA version. 3 old SAP ECC 6 versions and 1 SAP HANA version is more manageable than having one SAP instance and multiple other different ERP systems. So, it really all goes back to the unique data structure, here on the top right, the unique data structures in each system and tracing back the data that you need back to its source in the system. And so that's going to be easier when you have different versions of SAP, because they're going to be far more similar than between SAP and a JD Edwards system or an Oracle system. And there will be incremental effort and cost for each system. So, as you think about your roadmap to do this, implement this, you might want to, again, take a risk-based approach to bringing these systems on board and potentially phase them in. So map your systems to the geographies or business units of greatest concern, for example, and see where you can get the most value. So say your company is moving to a major instance in the next 24 months of SAP, is moving to SAP S/4HANA in 24 months, then you may want to just start there and just automatically phase markets in as they go live onto SAP. But let's say that your highest risk markets are not supposed to go live until 2026 on that system. So, in that scenario, you may first want to talk to your SAP roadmap team to see if there's any way to change the order and bring some of those higher risk markets in first. Now, that might be a tough sell, particularly if you don't have like an investigation or a monitor or something like that. If that doesn't work, you may then decide to add that SAP instance on the old version ECC6 to the rollout earlier, even though it'll eventually be sunset as that, instance moves into HANA. So you have to make that kind of risk determination yourself. And there may be a point where some straggler systems might never come on board. They're not going in, the market's too small, it's never moving over to SAP. And we may just say, for the level of effort and the money involved, we're not going to bring the system in. We might have some separate analytics or manual auditing that we do for those programs. And so long as you can kind of have a defensible approach from a risk perspective, you should be fine. So, great question. I think it's always the tough scenario when you have those multiple systems. It's just a little more analysis you have to do up front. And again, I think all of this is a roadmap. So think about this not as a one-year project in most cases, but maybe, a 2-3 year roadmap if you have multiple systems. The second question that came in is, how do you deal with the challenge of data completeness and data cleanliness? Are there scenarios where the data is so complete or unclean that you can't work with it at all? Another great question. All right, so this is I think this is one of the more significant areas that we try to help demystify for our customers, because this is an obstacle in many compliance officers' minds. I think partly it's because the compliance officer is not a data expert usually, and so they hear or know that there are areas where their data is not clean, or our vendor classifications are so broad. Everyone, half of our vendors are marked as good supplier or service provider and consultant or whatever, and can't really do much with that. So it's very common that we hear that data is not clean, it's not consistent, and it can feel like a real obstacle to moving forward. But typically what we've found from our experience is, and this is really important, having a major system like an SAP or an Oracle solves about 80 to 90% of the data challenges around compliance analytics that we see. It's really at the margins that you run into some of those limitations, but if you're, again, on a major system, you are 90% of your way there to having compliance data analytics. If you have kind of really one-off systems that are very unusual or not commonly used, you may be in a different boat. So I don't want to downplay that. But again, if you are on major systems that are widely used, most of your data challenges are manageable. So we do recommend pairing yourself with data experts within your company to deal with that other 10% issue, with finance, with IT, et cetera. But really, if you're on major systems, you really should not see that as an obstacle to implementing more advanced analytics. Something that we do at Lextegrity is we even do data workshops well in advance. So even signing a contract where we can walk your IT team, your finance team through the data process, the mapping, what we do. Again, unless your business is highly unusual, the days of a data analytics, compliance analytics project being a multi-year effort involving data lakes, outside consultants, and a whole team, I think are definitely long gone. So I think hopefully that's an optimistic note for all of you that are listening. So again, these are great questions. Keep them coming. So just to keep this moving, so I think the next step on the data side is automation. So I really want to delve into kind of the importance of automation here. The image you see here is kind of outlining the series of tasks that our system takes to transform raw data into well-structured, clean data that can be utilized by the risk engine. So you've prepared the data for analysis, what fields you need, but you actually have to then transform that data and combine that data together. And automation here is absolutely critical. If this process is not automated, it is going to erode the efficiency of your program over time and really undermine the whole program, and really, the whole process is going to deteriorate over time. Ideally, you'd love to do this automation running on a daily basis, maybe weekly, but to get really that real-time perspective, you want to do that in an automated, ongoing, daily way. So we're here going to talk a little bit about harmonization finally. So harmonization is really about transforming data into information that makes sense and can be effectively utilized by risk professionals. So in the images displayed here, you can see here two different risk domains. So you have employee expense and employee expense on one side, on the right, an offsite business bill, and on the left, you have a vendor payment. But you'll see here that the data is presented in very similar ways. They have a lot of the same crucial elements. You have a subject with their name, a timestamp for the transaction, the occurrence of the liability or expenditure, and then details of the payment method. For example, you have ACH. It might be, the values might be different. You have ACH on the left, and you have cash on the right. ACH for vendor payments and cash on the employee side. But really, despite those small differences, the data and presentation of the data is very harmonized. And why that's important is that harmonization allows your risk professionals to navigate this data much more effectively, quickly comprehend it and easily comprehend it, and then take appropriate action. Because here, the race is getting a handle on this transaction and resolving it quickly, whether it's a true issue or not, and what follow-up it needs. And here, you ultimately want to ideally enrich this information as well. So, not just the transactional level detail, but can you bring in things like the employee's 12 months of spend, or the vendor spend over 12 months, and really calculate this information and provide metrics that give more subject level context around this employee or this vendor. And so, why that's important is that, it then allows you to really drive, more insight around what to do with this transaction. So, if you see an anomalous meal, a $500 meal around Christmas on the right side, let's say, in that employee T&E transaction, it may be very different for you if that same employee has spent $175,000 in T&E expenses and is in the top 10% of spenders versus has spent, $2,000 of expenses and is not. So, having that additional red flag, additional context can help you really parse through the red flags that your transaction monitoring tool is identifying for you. So we've covered, I think in some detail, the data piece. So I want to now jump over to the methodology side. So, it's really essential here to understand that your analytics relies heavily on following a methodology. And so, methodology, and by methodology, I really mean, kind of a process for identifying and then assessing those risks, which, should be managed through first, like a comprehensive risk assessment, and, to identify the areas of biggest risk for your company, and then have that risk assessment drive, the areas of focus, as well as how you set up your risk analysis engine. So, the crux of this methodology section discussion is going to revolve around understanding and prioritizing your risk, and then delving into the process of risk ranking. So, once you've done that risk analysis, you've looked at your risk assessment surveys, you've looked at your investigation dockets, proactive reviews, et cetera. That's going to really give you a basis for, where you want to look, what domains that you even want to start looking at. Do you want to focus on employee expenses or vendor invoices or distributor transactions or agent sales rep type of expenditures and expenses. And then your things like your investigations docket, your proactive reviews are going to actually show you the specific schemes and other things that are going to help you figure out how you're going to risk rank things and also set up your analyses. So from a risk ranking perspective, methodology really has three components: risk ranking, setting a threshold for your monitoring, and then setting the specific analyses. So in risk ranking, ultimately companies, when you're running a program like this, you're dealing with a very large volume of transactions, sometimes hundreds of thousands or millions of transactions, and sorting through them all manually impossible. So that's where risk ranking comes in. It helps you to quickly identify the transactions that have the most risk. So as I've talked about at length now, risk ranking involves aggregating the results of all your analyses for one particular transaction to come up with an aggregated score that can be prioritized for review. So your highest risk transactions are going to go, excuse me, to the top of your list from a risk ranking perspective. And so here you need a methodology or formula for aggregating all of those analyses results. And there's a variety of ways to do this, but really the two foundational components of this is really volume and value. And so what I mean by that, those two foundational fundamental components are the volume of risk results for the transaction as a whole. How many separate risk results or key indicators do you have? Obviously, the more results you have, the greater the risk, but then also the value of any particular risk result. So you may have a high volume of risk results, but what are the values of each of those risk results? So how severe are each of those risk results, and how important, excuse me, is that risk result to your analysis? So it's a combination of the volume and value of those analyses that drive the ranking of that risk. So, you have to really consider, as you think about the volume and value considerations, you need to think about the variety of your analyses. So some of your analyses may be very targeted to detecting risk. So is a vendor matched to a name on the OFAC watch list? Was the payment expedited? Was the cash value of an expense high? Again, very kind of binary. And so those could be very targeted risks. But then some others might be more secondary risk factors that are more kind of qualitative kind of risk indicators. So, is the subject a high or frequent spender? Was the merchant in a high risk category? These are ones, was the transaction value round? These are ones that have a little more gray to them. So it's a combination of, for each of these more targeted analyses and these more secondary risk analyses, looking at that kind of volume perspective and to give you a sense of kind of how to set these things up to give you the best risk ranking possible. So when doing these analyses, there's really different ways to do it. You want to be able to pick and choose your analyses that make sense for the data you're looking at, and be able to tweak these analyses over time so that you're not getting a lot of false positive and your risk ranking isn't getting skewed. So I'm going to move on to monitoring threshold and analysis settings next, but I do have another question. So how do you establish these risk analyses? Is there some sort of global standard like ISO? Okay, great. That's a wonderful question. So I know ISO has been doing a lot of work recently in the risk space, so I could see why you would ask that question. So, unfortunately, I'm not aware of any centralized kind of publicly available database of best practice analytics for compliance risk monitoring. Typically these analytics are developed, more on a proprietary basis by, companies, by their internal teams, by accounting firms, companies like us, like Lextegrity. But that being said, I would say there are resources like ACFE, the Association of Certified Fraud Examiners, who do have best practice documents, OECD and other organizations, that can walk you through some common data analyses that can target non-compliance. So I think those could be some good places to start. But again, I think those are going to give you pretty high level thinking or requirements, then kind of operationalizing those into analytics, taking the data, combining the data, applying it to data, and then coding those analytics is kind of the next step, which, ultimately, I think you still need good forensic accounting experience, people who've done investigations using data analytics. Those are the types of, human resources that you would need to really turn, best practice analysis, best practice thinking of analytics into true analytics. So, hopefully that helps. But I really do think, it's, again, a good point. I think this really is one of the challenges in this space of trying to build analytics internally, is really hiring all these people and finding the right skill set. And I do ultimately, maybe want to highlight that, not all data analytics approaches and professionals are also equal, just like any other skill set out there in the world. Maybe one example of kind of another quote unquote older school approach to data analytics is really just kind of piling on key risk indicators, multiple analyses that really look at the same thing. I think this is one that we've seen come up recently where companies have looked at providers that do this or have thought about this as an approach. So, and I really want to kind of maybe educate folks on really being wary of approaches like this. So maybe just to be a little more concrete, you might have an analysis that, let's say, is looking at duplicate vendors. Maybe that's an easy one. Looking at duplicate vendors in your financial transaction. So kind of an older approach to this would be kind of using multiple analyses for this. So maybe 4 or 5 different analyses. So KRI1, we're going to compare vendor names to one another and see if there are any duplicates. KRI2 is we're going to compare vendor addresses, so names is 1, addresses is 2. Analytic 3 is comparing vendor phone numbers. Analytic 4 is comparing vendor bank account numbers, and so on and on. So you might get 4, 5, 6, 7, 10 of these analyses that at their core is really trying to validate whether there's a true duplicate vendor or not. So if you have a true duplicate vendor in this scenario with an approach like that, what I call kind of an older, outdated approach, is that you might have matches for all 4 or 5 of these analyses. So now you're looking at that, you're looking at that one fact that it's a duplicate vendor, and you're seeing it as 5 separate risk indicators, which is excessive. But beyond that, it's actually the harm here is that it's ultimately diluting your other analyses for that same transaction. So to maybe make this even simpler to understand is, if that same vendor who has 5 duplicate matches is also on the OFAC sanctions list, we mentioned OFAC before, and that's presumably a very strong risk indicator. That risk indicator is going to be watered down a ton by the fact that it's now 1 of 6 key risk indicator matches as opposed to 1 of 2 analyses matches. So when you think about it, there's really 2 matches here. It's a duplicate vendor, that's 1 attribute, and it's on OFAC. So it really should be a match for 2 analyses where the OFAC match is half of the score, let's say, just to keep it crude, half of the score, and the duplicate is half of the score. But in this case, the OFAC might end up being 1/6 of the score, while these 5 duplicate attributes take up 5/6 of the score. And now you maybe not even look at this transaction as quickly. You may never look at it, or maybe you don't look at it as quickly because you've got higher risk things that you have to look at, and now this OFAC piece of it has really been watered down. And so, that's maybe hopefully a helpful example, but again, it's math ultimately, and I think when a lot of compliance officers look at some of these approaches and tools, some of this real granular level analysis is hard to do because it's so deep into the data. But that is a big difference in approach when you have these multiple key risk indicators when they're looking at the same thing. That can have some really significant impact on your overall data analytics program, and you may get lost in your analysis. And you sometimes may hear people talk about, well, we have 150 analyses, we have 200 analyses, and really it's about the quality and approach rather than necessarily the overall number. So I hope that answers that question. Went on maybe a little long on that, but maybe hopefully that was helpful. So moving on to the next piece, once you have your risk ranking methodology set up and you have some legs there, you need to define that threshold above which you want to look at transactions. And this is critical here. Nobody has the resources to review every transaction. That would defeat the whole purpose of this, of taking a risk-based approach. And ultimately, you want 2 things here. You want a threshold that's low enough to capture enough transactions for review that are high risk, but high enough to limit, the total volume so as not to overwhelm your team and to ensure that, you get high quality results from your program. So overall, you need to accept some level of noise in order to expose transactions. You're going to have some false positives to find the true risk. But you also want to make sure that this is something you can iterate on over time very quickly without having to do a bunch of coding, because you may want to ramp up your risk score threshold, ramp it down if you have more resources, etc. And you want to do that in a much more dynamic way. And then finally, we come to the analysis settings here. So up to this point, we haven't really discussed the real meat of the continuous monitoring program is the analyses. We've kind of touched on it here and there. We talked about KRIs, but it's really the setting of those KRIs that's really critical here. And there's really kind of a few components to each analysis. There's the actual logic of the analysis. That's, how does the analysis work? The reasoning that gives you the key risk indication and the key risk metric. So here the logic should be intelligent, and if you're looking to profile your employees by their spend, for example, do you want to use airfare and lodging in that? Do you want to break those out because you could have very high dollar value airfare transactions that skew your data? So you want that logic to be really well thought out. And then ideally, you would want a process or a system where you can create really bespoke logic on the fly as well. So, I've mentioned offshore bank accounts before, and having a tool where you can really build bespoke logic, or having a process where you can do bespoke logic is really powerful. And offshore bank accounts is a good example. If you have an offshore bank KRI and that's all you can do, you're going to get a lot of you may get a lot of transactions where you might get a Swiss company with a French bank account. Again, may not be the highest risk thing that you have in your data, but if you have a tool that allows you to build on top of that to say, look, we're gonna really focus on offshore bank accounts for our Russian vendors, and put a higher risk weighting on those, or look for any company that has an offshore account in Cyprus or a certain other high risk offshore jurisdiction. And maybe you've had investigations issues related to certain countries and offshore bank accounts. Being able to do that granular level of analysis setting really will take your analysis, risk analysis program and your data analytics program to the next level. And so, the understanding here is the logic is the first component, then the scoring itself is the second component. So that's turning your risk logic into an actual risk result that encapsulates the risk of this issue, and then overall weighting that transaction. So how good is that analysis at detecting risk? And that's going to get better over time with machine learning, etc. And your settings will get better over time. And you'll want a system where ideally you could also get feedback to your admin to get better over time. But ultimately, the key takeaway here should be this is an area of continuous improvement. No company should turn on a data analytics program and settings and then forget about it, because you're going to get a lot of noise. Your business is going to change, your exposure is going to change, your schemes are going to change. And so having flexibility in your settings is critical for a variety of reasons that I mentioned, but ultimately having that flexibility, having the ability to modify the underlying logic and settings is what's going to really make this scalable and long-lasting and sustainable. And in the investigations context is a great one where we've had customers have investigations pop up and they can immediately start monitoring the vendor or the employee in that investigation. And even if at the end of that investigation they can't substantiate the matters, they can continue to put a higher weight on that subject in the monitoring, because they can set those settings in our platform without having to do any coding or anything like that. So we have another question here. In your experience, who at a company typically manages these settings and how often do they make changes? Good question. So typically with our customers, and it might be unique to us, it's managed by someone in the compliance function, maybe sometimes working hand in hand with audit and finance. But really that's driven, and depends a lot on the approaches and tools you use. So if you use a tool that requires analytics coding or SQL or engineering to create or modify your analyses logic or edit their weighting, etc., then managing these settings becomes a much more laborious and cross-functional task, needing IT, specialized skill to manage. So you want to add a keyword, you want to change the weighting of a GL account, and you have to go in and actually do that in SQL or Alteryx or wherever, that's going to be a very different beast than something, like our tool or, and potentially other tools out there that is a no-code platform where, any compliance officer with no technical skill can modify these analyses, build their own custom analyses without needing any specialized skills. So our customers are modifying these analyses multiple times before they go live. We're rescoring transactions so they can really right size and target their analyses and build specific analyses for their business. And once they go live, they can continue to tweak these analyses, from an investigation, from a proactive review, et cetera. I'm a big believer that having this process and this approach of setting analyses be non-technical makes a data analytics program more effective for sure, but much more sustainable long-term. So thank you. It's a really good question. So finally, let's go. We're going to talk about the last step in the stool, and I think we're coming up on time here, or maybe even going over time a little bit. But thank you for your patience here. So process is the third step of the stool. And really there's three components here: identifying the root cause, identifying a transaction and its root cause, remediation and tracking, and ultimately your mindset around your transaction review. So when you have access to the transactional detail, you can go deeper and understand what actually happened with this transaction. You can research why the specific transaction has a high risk score, and what's driving it. So here, if there is an expedited payment, you can see here, it has a high risk score. It's driven by the fact that there's an expedited payment. We can then analyze not only the invoice data, but also the purchase order data, the PR data, the payment data. And then looking at all that data, we can identify the inconsistencies. Why did this happen? Maybe we need to talk to some employees to understand what happened here. Maybe it was just a control gap, a mistake, or maybe it was something more critical. And then we can follow up and then ultimately document all of these follow-up steps, as well as remediation steps, which we'll talk about in a second, all in one platform. So it's really critical that your reviewers have sufficient data to start their process and that they can do that in a comprehensive way, but that ultimately you can give your reviewer that data, context around that data, and then they can do all their work ideally in one system and document that all in one place. And that kind of goes to remediation, this remediation and tracking here. So, both the follow-up as well as the remediation. So often, when I was in-house, the remediation related to employee issues, termination or warning letters, that would get done really quickly, but other remediation like updating the policy, doing training, et cetera, would be really hard to track and manage, and people would change roles. In an ideal system, you'd want to track that all in one place so you can kind of see that, report out to your management about those things as well, whether it's discipline, control enhancements, et cetera. You want a dashboard where you can monitor the number of transactions monitored, who reviewed them, how they were reviewed, the resolution, how many were remediated, et cetera, and the types of remediation. And having all of this workflow in the same tool as your analytics will make your life much easier. So, using a tool that's not built for this, like SharePoint or an e-discovery, document review tool, is really, really suboptimal here. So you should make sure you factor that step into the process if you're looking to build something like this, or if you're looking to buy something like this. Really assessing the vendor out there to make sure that they really have a robust tool to manage follow-up workflow, and it's not just kind of something like an e-discovery tool where you can just clear the transaction or not, like as if you were marketing it as privileged or not privileged. That's going to be very limited in terms of what you want to do. And then finally, and this is our last slide here, is really what's the overall mindset and really changing how your company manages this data, because it's not just the one-off transaction reviews you're doing. You're bringing in this transactional data, you're risk scoring it, you're identifying and remediating it, but then it is a continuous improvement feedback loop. You're then using that identification and remediation data to give you overall results for your program, as I described, the number of transactions, what percentage have had issues, how are you remediating them. You then want to continue to adjust your settings to make your analytics engine even stronger over time and identify even higher risk things. You may see new risks and schemes in your investigations or your data, and you want to feed those back into your program, into controls, as well as your settings, and then continue to iterate on those analyses over time. And that will then go back into more transactional data, more risk scoring, more identifying and remediating, et cetera. And so that's what makes this really a loop that goes back to back into the program. And so that's where that continuous improvement comes in. That's where the risk-driven element of this comes in as well. And so I hope you're seeing this kind of end-to-end process of continuous improvement. And hopefully I'm leaving you all on a good note here of optimism about how a good compliance data analytics program could work. So that really concludes our webinar today. Thank you so much for your engagement. Some really great questions. If we did not get to your questions, we will reach out to you after this webinar. And we are always happy to reach out, to connect with you. Feel free to reach out to me on LinkedIn or over the email that I shared earlier. Go to our webpage. We have a number of great case studies, as well as white papers, ebooks, and other resources. We have an email box, and we are happy to talk in more detail with you and your team, to do data workshops, et cetera, as you look to enhance your compliance data analytics capabilities. So thank you very much again, and have a great rest of your day.